Welcome to my second video of our series Basics of Accounting. Today I will be explaining you all the basic concepts of accounting. These are very important in anyone who want to know accounting. So be with me till the last of this video. So the concepts, why concepts are required? See, when you do accounting, when any company do accounting, these accounting records will be checked by various people. Now, who are these various people? People might be included from government authorities like Income Tax Department, Ministry of Corporate Affairs if you are a private limited company, or maybe some people who you purchase goods from and you have not paid them. So they are your creditors, or the people who you sold goods, they are your customers. So your customers, your suppliers, and many other people might want to know what are your profits. Now accounting concepts, because they are standardized and everybody use same concepts, this helps in standardization of all the records. So same industry, if there are three and four and hundreds of companies doing accounting, they will not use their own concepts but will follow this, and because of that their records will be same, and hence comparison of accounting or comparison of their financial statements become easy. Okay, now I might have said lot of words which you people might not have understood in this, like financial statements or any other word, but trust me, in coming videos I will explain every concept in detail. So let's start with basic concepts of accounting today. Okay, so the first is business entity concept. What is business entity concept? So let's say this is a business of the company, this is a factory, and the manufacturing is taking place in this, and this is house of the owner of the business. Now in house, whatever owner is spending is his personal expense and not related to business, and therefore whatever expenses, whatever spending, whatever any other things, whatever, like if the furniture is purchased at home, AC is purchased at home, TV is purchased at home, these are not related to the business, these are not business expenditure, therefore they are called personal expenditure. All these personal expenditure are denoted in accounting records as drawings. Remember this word, we will be using it various times in future. Okay, and business entity concept states the difference between a business and the owner. So a business is differed from the owner, disattached from the owner, and therefore his own expenses and business related things are separated. The second important concept, money measurement. I think I might have said this in last video as well. Accounting is done only for the records which are related to money, where there is transaction, where their monetary exchange is being done, and therefore if you see salary paid or for purchase of goods, you are paying something, somebody is receiving money, somebody is giving money. But for skills, or let's say if you say I have good reputation in the market, yes, reputation is very important, but because that cannot be converted into monetary terms directly, you cannot measure it, it is not included in accounting records. So accounting is only done for money measurement things. Whatever transaction includes money giving and money taking only are recorded in accounting records. Going concern concept. This is very important concept, going concern. Now what this concept means is that business will continue for foreseeable future. That means the future which you will be, future which you can see, like 5 years, 10 years, 20 years, you assume or you think that business is going to be continued. If you have any reason to believe that no, because of some reason business might not be continued, then this concept is not in place. Then what? Then what? I will explain you in later videos. But in normal scenario, everybody assumes while doing accounting that business is a going concern business. Okay. Next, accrual concept. This is very important concept. What is accrual? Accrual means record transaction. So you have to enter the transaction in your books when actual event takes place. Okay, actual event takes place. Now, what is event? Event is, let's say I have employee in my office. Okay, so he has worked from first day of this month to the last day. For 31 days he's working in my office. Now the event of receiving services from employee is being done during the month. Now let's say I pay him salary next month on 7th, but the expenses is related to this month because his services is taken in this month. Therefore, though the payment is made in next month, expenses are related to this month. Okay, so just an example, I will take Jan and Feb. So working is done in Jan, but payment is done in February, but expenses will be related to January. That is accrual concept. Accrual concept says that payment might be done today or payment might be done in future anytime. So payment is not the way to record the transaction. What then, on what accounting transaction should be recorded? It is recorded based on the events that are taking place. So as and when they are accrued or earned, on that basis you have to record. So remember, this concept is very important. Matching concept, again one important concept. When you spend something, every business spend something to earn something. So let's say I purchased what? I purchased a pen today for of 10 rupees. Now I want to sell this pen in the market for 15. So I purchased on in January. Again, I will take same example, January. But due to some reason, I could not sell in the same month. In February, in February, I sold it for 50. Now, without matching concept, what will happen? That event of purchase is in Jan. So I will say that my expense is in Jan, but there is no income. Therefore, only expense, no income, it is a loss. But in February coming in month, there is no expense, only income of 15, so all profit of 15. So this is not allowed. Your expense and income should match together and they should be forming in the same month. Okay, that means 15 is income of February, and in the same way 10 is expense in February only, and therefore profit will be 5 in February and nothing will happen. No profit or loss will happen in January because only purchase of pen is done. So pen is still in your stock. It is still in your hand in January. It is not sold. Okay. So this is matching concept. Consistency. Now there are various methods in accounting. In each of the things, accounting gives you choice that either you go by this method or you go by this method. But when the transaction taken place for the first time, when your business starts, you take the decision, okay, I will go by any one method. Okay, and when the choice is made for the first time, it should be consistently applied over the period of next years. So you don't change the methods ever and every year, because it will not be consistent for the accounting records. Okay, you can change methods, but then the consistency breaks, and then there are other repercussions. I will explain those in future, but consistency concept is to be followed. Prudence. Prudence is again a very important concept. What accounting concept says prudence is, you have to think and record all kind of your expenses or losses. But when it comes to income, you cannot do so until you are 200% sure that yes, you are going to earn this income. Okay, now I will explain this in a while. So basically, let's say you lend money to your friend. Okay, you know that you have reason to believe you have lent money to your friend in the past, and he is not going to give you back your money. So basically what prudence concept says, though you think that the money is only lent and it is not given forever, that you know, but because of the past, the friend is not going to pay you back. So assume that by prudence concept, your money is gone. That is your loss. And you record that loss in your books. Do not think that he will give you back. But in case of gains, let's say you basically you have got something, you have earned something, but you do not have any reason to believe that the money will be coming in. Like you sold some goods to your other friend, so you earned something, but the friend is not going to pay you, therefore unrealized gains. So your income is not to be recorded unless you are 100% sure that the money will be recovered. So prudence concept is also very important concept. Okay, all the concepts are done for the day, and I want you to stay with me to subscribe, like, and share my channel. And I will be taking up whole accounting series in one by one in all videos. Stay with me. Thank you.